Hey guys, this is Hayden Harrington with Momentum Multifamily, and today I'm going to talk about what is a cap rate. So I'm sure if you're interested in multifamily or commercial real estate in general, I'm sure you've heard this term cap rate. So what it really stands for is the capitalization rate on an investment opportunity. So essentially what that means is that's the rate of return that you would receive if you paid all cash for an investment opportunity, meaning on an unlevered basis, or in other words, you don't have any debt. You're paying all cash, you're not getting a loan, you're not getting a mortgage, and that's the rate of return after income and expenses on the amount invested. So what I'm going to do real quick is I'm going to actually share my screen and show you this cool little tool that we created to help you not only calculate it, but also see the value you can create using cap rates over time, over the life of an investment opportunity. So first, we're going to look at this going in cap rate. So on this example property at 123 Main Street, it's 183, or it's built in 1983, and it's 161 units. So on this example, we're looking at it for $20 million with a net rental income of $2 million, and net operating expenses of $1 million. And this calculates our NOI of $1 million. So how we get a cap rate is, if we look here at this formula, all it is taking the net operating income and dividing that by the purchase price. So that's the formula for calculating cap rates. So you can see your going in rate, or the rate of return, again, if you paid all cash at purchase based on the historical performance of the property. So to get your net rental income and net operating expenses, you're going to want to look at what's called a T12, or any sort of financials over the last year, as recent as possible. So if you go to a seller or you go to a broker, ask for T12 and a rent roll ideally, so that you can see what the net rental income is, what's the net amount in rent and other income that they're collecting, and then their net operating expenses. So those expenses associated with running the property. So your net operating expenses, again, since we're talking cap rates here, does not include your mortgage expense, does not include debt. So net operating income, again, is all your income minus your expenses, except for your debt, that generates your net operating income. And so cap rates are a function, assuming that you're paying all cash, right? So you're not factoring in debt here. So if you paid all cash on this example, you get a 5% return basically. So cap rates are really helpful too when you go to value a property at the sale. So let's say you're looking at this investment and you're looking at holding it for 5 years. So what you can do is come in and input your expected net rental income 5 years from now, and then your net operating expenses 5 years from now as well. And it gets your increased NOI. And then what you do here is you can input a cap rate. So you can look at the value created based on different cap rates, and these cells up here will change accordingly. So at a $1.2 million NOI, let's say you've increased the rents, you've been able to keep expenses relatively low, and now you've created $4 million in value, or your property is worth $24 million. So how we get that is, again, taking the net operating income and dividing that by your expected sale cap rate. Now, the expected sale cap rate is a bit of an unknown. That's a little bit harder to quantify. It's harder to kind of justify. Institutions on average look at 10 basis points per year over the life of the investment. So if you're looking at a 5-year hold, that's 50 basis points on top of your going in cap rate. So in this example, that would mean an exit cap rate of 5.5%. So that's kind of a general industry rule of thumb, and you can base it roughly around that. So in this example, if you want to be more conservative and account for some cap rate expansion, which means a weaker market, because just because things are maybe hot right now and everything's going well, you don't know what the future is going to look like. So you want to build in some buffer and see, okay, if there is some cap rate expansion where a market softens a little bit, what is my rate of return there as well? So in that instance, again, you can see a sale value of 21.8 and about $1.8 million in value created if you're able to hit these numbers. So again, this is just a quick tool to calculate a going in cap rate. That's an important factor to know what sort of rate of return you're getting on the front end on an unlevered basis again, and then also to project your potential future valuation as well, based on what you think the net rental income and net operating expenses are going to be in the future based on your business plan for the property. So again, I hope this helps. If you want this free tool, happy to give it away to make it super easy. You don't even have to think about it, do any calculations, just plug in a few basic bits of information and it'll spit it out for you. The link to this Excel model is in the description below.